Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely, we have Dave Mazza. He's the Managing Director and Head of Product over at Direxion. We're going to learn about portfolio risk mitigation using ETFs. Dave, it's great to have you with us as always. And while not in studio, we appreciate you making the time.
Of course. Thanks for having me on.
All right, and you got it. And you know what? We are at the close of the first quarter of 2020, and certainly unprecedented, the worst quarter that we've seen since 2008. High level, what are you looking at here?
Yeah, no, you're exactly right. We have been on a wild ride this month. And in fact, if we hadn't had this rally that we've seen, while we believe it is a bear rally, the situation, at least when it comes to performance, would be even worse, which is just remarkable. The percent of days that we've seen up and down from a wild swings perspective has been difficult for many to absorb because we are coming out of an environment where we've seen extremely low volatility. With that being said, we've seen a significant amount of fiscal stimulus, significant amount of monetary stimulus that's helped give the market a bit of a firmer footing, all else being considered with the number of question marks that still exists out there for investors to navigate.
All right, let's take a look at your first slide here. And this is around, safe havens have suffered due to deleveraging, just like all the other asset classes as investors look to move into cash. Do you think this could be a good setup for them to eventually perform?
Yeah, it's really interesting. So if we think about traditional safe havens, especially an asset like gold and other precious metals, they really suffered in some of the first part of the sell-off. A lot of that had to do with the aggressive deleveraging that we had seen across leverage funds, whether they be hedge funds, risk parity funds, or the like, as investors looked for any asset that they could turn into cash quickly. And in fact, gold, along with long-term treasuries and the like, had some exceptional performance year to date and on the trailing 1 year. So it was a good source of cash for those investors who needed it as investors were flying to safety, especially out of the riskiest parts of their portfolio. But we actually saw a similar experience in the 2008 crisis, where in the early part of that, some of the safe havens did see their prices fall, but eventually they got on firmer footing. Well, why is that the case? It's because just like last time around, we're going to have an exceptional amount of debt added to the economy, an exceptional amount of fiscal stimulus and monetary stimulus. What that does is it really increases the need for investors to think about having more defensive parts of their portfolio, and especially assets like gold or even long-term treasuries, even with the volatility, can still serve as that for investors alongside their stocks.
Let's take a look at our first chart here, and this is the Direxion Flight to Safety Strategy ETF, ticker symbol FLYT. They sure get really clever here. And we're taking a look at the performance from the beginning of February to where we are now and how that looks relative to the S&P 500.
Yeah, so we really created FLYT, which launched earlier this year. So certainly luck from a timing perspective to be a ballast for investors' portfolio. And what does that mean? It just simply means that it's in the three assets that it holds, which is gold bullion, long-term treasuries, and utility stocks, are uncorrelated with one another, and they're uncorrelated with the S&P 500. So what we tend to see is during periods of volatility, during periods of drawdowns in the stock market, those three assets actually tend to be a ballast and do well, and we've seen it in this period. So again, FLYT, in a very simple way, combines those three assets together for you so an investor can use it alongside anything else they may be doing in their broader portfolio.
And in our second chart, we can see how FLYT is performing relative to those other safe haven assets.
Yeah, exactly. And we show this for a reason, because many people say, well, I'm fine with just using gold, or, hey, I actually tilted my equities to be more defensive. I'm all in utilities, for example, or I'm somewhere in between. I'm just sticking with bonds. Well, what you can see is that during these periods of volatility, each one of these assets actually can still perform differently, whether we're looking over the long term or over more shorter time periods. So to me, it makes sense to combine diversifiers together in a single diversifier to especially equity-centric portfolios. So I can't, no one can tell you with surety whether this is going to be the best environment for gold, the best environment for stocks, best environment for bonds. It makes more sense to combine them together in a bit of a trinity and have it in their have it in your portfolio to be that sense of safety when investors are flying for and needing safety. So you don't necessarily need to run for the hills along with them because you already have it in the portfolio.
All right, Dave, great to catch up with you as always. Look forward to getting you back in the studio.
Yes, thanks. Thanks to you.
All right, and thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.